Good morning, everybody, and welcome to Higher Rates, Shifting Markets, Thriving in Today's CRE Landscape. I'm your favorite real estate coach, Loren Keim, and I want to clear the air right now. The sky is not falling. So many of you call me and say, we can't sell anything right now. The cap rates are too high. The owners don't want to sell. The buyers don't want to buy. Let me explain something. It's just gotten a little bit more expensive to finance. Kind of like going to Starbucks and realizing that your regular order is now $9.50. You still need the caffeine. You just have to be a little bit more strategic about how you order it. So today we're going to talk about exactly that, strategy. How do you, as a commercial real estate professional, not just survive in this environment, but thrive? And we're going to cover what higher interest rates have meant for values and deal making, what tenants and buyers are actually looking for, and how you can position yourself as their trusted advisor when clients are feeling cautious. And yes, we'll sprinkle in a little humor along the way. Because if you can't laugh in this business, you're probably calculating IRR spreadsheets for fun. And let me be honest, that's not healthy for anyone, is it? So why are we here today? Commercial real estate is in a period of transition. We all know it. We came out of an environment where cheap money was everywhere, deals were flying, and now, well, things have slowed down a little bit, haven't they? Rates are up. That's not news to anybody on today's call, but what it means is that values are adjusting. Buyers are rethinking their pro formas, sellers are trying to hold on to yesterday's numbers, and deals are taking a little bit longer to put together. Now here's the good news. Your clients are nervous, and that nervousness, I hate to say it, that hesitation is not a threat. It's an opportunity, because when people are uncertain, they need trusted advisors more than ever, and that's you. They need someone who can cut through the noise, explain what's really happening, and help them navigate the market with confidence. And again, that's you. Think of today's market like riding a roller coaster. There's hesitation before the big drop. A lot of screaming along the way, isn't there? But if you hang on and play it smart, you will usually end up laughing at the end. Maybe not me, but most people. And your job is to make sure your clients keep their seatbelts on and ride it through, whether that's helping them find the right buyer, the right tenant, or maybe the right investment. So let's start by discussing everything about financing, because this really is the engine that drives every deal. Without financing, the best property in the world is just sitting there like a Ferrari with no gas in the tank. Here's what's happening right now. Interest rates have climbed. I know they've stabilized. In some areas, they've come down a little bit. But that changes everything, because higher borrowing costs mean investors can't pay yesterday's prices and still make the numbers work, can they? As rates rise, cap rates have adjusted upward. And that's a fancy way of saying that the returns investors demand are higher, so values are coming down to match that reality. Now put yourself in the shoes of an owner who financed at 3.5% 5 years ago. Their loan is expiring, and suddenly they're staring down a refinance at 7 or 8%. Their debt just doubled, and for some, that's manageable. But for others, it's an absolute nightmare. And that gap, that pressure, is where opportunities pop up for buyers, for brokers, and for creative deal makers. So what is working? Creativity is working. Deals aren't dying because properties are bad. They're dying because the math doesn't math. The math doesn't line up unless we bring in new tools. So let me give you a few ideas. Number one, today I'm going to talk about loan assumptions. Taking over the seller's existing lower rate financing might make a deal pencil out if you can. Second is seller carrybacks. Convincing the seller to finance part of the purchase can bridge gaps when banks won't. And then mezzanine equity or preferred equity. Yes, it's more complex than that, but it can unlock deals that others walk away from. This is where you as a broker become more than a tour guide. Anybody can open the door and point to the conference room. Your value is when you can say, here's 3 ways we can structure this deal to make it work, to make it cash flow. Because in 2025, financing isn't just part of the deal, it is the deal. And if you can talk confidently about these structures, you're not just showing properties, you're solving problems. And one more thing. Don't underestimate how much clients appreciate you demystifying this. When you can take the stress of financing and turn it into options, you move from being a salesperson to becoming that trusted advisor I keep talking about. And that's where loyalty, repeat business, and referrals really truly come from. Now let's shift our focus for a couple of minutes to the demand side of the market. Because even in a financing-driven environment, Deals don't happen without having tenants and buyers. So let's talk about tenants first. What we're seeing is a push for flexibility. Tenants aren't always looking to lock themselves into 10 or 15-year leases anymore. They want shorter terms, renewal options, and the ability to pivot if their business changes. Why? Because we live in a world where companies don't know what their headcount is going to look like in 3 years, let alone 10 years. And it's not just lease length. They want tenant improvement dollars. They want landlords to help them customize space, whether that's office build-outs, upgraded HVAC systems for medical tenants, or warehouse improvements for logistics. For many tenants, TI is the make or break factor in the deal. Now, what about buyers? Buyers are laser focused on certainty of income. They want strong tenants, they want long-term leases, and properties that won't surprise them 6 months after closing. Stability sells in uncertain times. Now, that doesn't mean investors aren't taking risks. It just means that they're calculating those risks more carefully. They're asking, how solid is this tenant's credit? What is the rollover schedule? What are the capital expenditures going to look like over the next 3 to 5 years? And here's where the asset classes really tell the story. Some are thriving. Industrial properties, still hot. E-commerce, supply chain, and last mile logistics are really driving that. Medical office continues to be strong thanks to demographics and healthcare demand. Data centers are exploding as AI and cloud storage gobble up space. Now, on the flip side, traditional office space, especially older Class B and Class C stock, is struggling. Remote and hybrid work changed the game, and a lot of that space just doesn't meet today's needs. Weak retail centers are having a hard time unless they've got grocery anchors or experiential tenants that are pulling traffic. Now, office space right now is a little like kale. Every year someone says it's making a comeback, and yet most of us are still quietly avoiding it. So what's the takeaway for you as agents? You have to understand these shifting preferences and speak your client's language. If you're working with a tenant, show them flexibility and tenant improvement options. If you're working with an investor, highlight stability of cash flow and tenant strength. And if you're working with sellers, prepare them for the reality. Buyers are pickier, and properties that check the right boxes will move faster at a stronger pricing. This is where you as the agent can really shine, the tools you bring to the table. And again, let's be honest. Anyone can walk a client through a building and say, here's the lobby, here's the office space, and here is the bathroom. That's not value, that's a guided tour. Real value comes when you layer in tools that help clients see the bigger picture. We're talking about things like GIS mapping, demographic overlays, and of course, AI-powered comps. These aren't just shiny tech gimmicks, they're storytelling devices. And stories we all know sell, don't they? CoStar remains the big player for comparables, leasing data, and tracking competitive properties. Yes, it's expensive, but it gives you credibility with investors who expect you to know the numbers. The Analyst PRO, we talk about that a lot on this program. It's one of my favorites. It's quick, clean, and client-friendly. You can produce demographic reports, location analyses, and even simple investment models in minutes. It makes you look sharp without a week of data crunching. And both of these have GIS components that allow us to show what's going on around it. And don't forget the free tools. ESRI's ArcGIS and even Google Earth can take your presentations to another level with mapping, layering, and visual storytelling. Sometimes even a simple aerial with traffic counts marked out can be more persuasive than a dozen spreadsheets. And for those of you who are CCIM members, there's also CCIM's Site to Do Business platform, which includes Business Analyst, which is powered by ESRI. That's a powerhouse tool for demographics, consumer spending patterns, and psychographics, helping you show not just where people live, but how they spend their money. When you show a client traffic patterns in front of a retail property, you're not just talking about cars. You're painting a picture of customers walking through their door. When you overlay income growth and household migration, you're not just throwing numbers at them. You're showing them future demand for apartments, for shopping centers, and offices. Put the data into visuals. Use heat maps. Use charts. Because let's face it, numbers in a spreadsheet might put your client to sleep, but a map with glowing hotspots, that gets their attention. Now here's the secret. Clients love pretty maps. They don't just see them as pictures, they see them as proof. Proof that you know the market, proof that their investment is backed by more than just your opinion. And here's the kicker. Those pretty maps can translate into commission checks. Why? Because you're no longer competing with the broker who just emails an offering memorandum. You're the one who can walk into a meeting and say, here's where the income's growing, and here's where the population is moving, and here's why this particular asset makes sense. And at the end of the day, a picture may be worth 1,000 words, but in our world, it could be worth a six-figure commission. All right, let's talk about what every single one of you has probably heard in the last 6 months. Rates are too high. This is the number one objection in the market right now. And here's the thing. You don't win the argument by arguing with it. And you don't win by agreeing with it. You win by reframing it. So here's how it looks. The investor says, I'm not going to buy right now. Rates are too high. And you say, exactly. And that's why values are lower today. You're buying at a discount. When rates normalize, values bounce back. So you're positioning yourself for an upside. In other words, don't fight the objection. Redirect it into an opportunity. Let me give you an example. Imagine two investors. Investor A waits for rates to drop. By the time rates fall, guess what happens? Competition floods back in, prices climb, and they're paying a premium. Now, investor B buys right now at today's discounted price, maybe with some creative financing. When rates do ease, their property value increases and they're sitting on appreciation. That's the conversation you want to have. You're moving clients from a fear-based mindset into a strategy-based mindset. And this isn't just theory. Smart investors are already doing this. They're negotiating harder, yes they are, but they're also stepping in where others hesitate. Think of it like Black Friday shopping. If you wait until crowds return, you're going to pay full price, and you'll still get stuck with that ugly sweater. The best deals always go to the shoppers who are willing to show up early. So when you're negotiating in a risk-averse environment, here's your formula. 3 parts. Acknowledge the fear. Yes, rates are higher. Reframe the fear. That's why values are cheaper. And paint the upside. When the market adjusts, you're already ahead. If you can master that pattern, you're going to move from being the broker who nods sympathetically to the advisor who helps them really take action. So let's look at a few other common objections we're hearing right now. The investor might say, I'll wait until next year, things will be better then. Have you heard that one? You might respond with, well, maybe, but let's unpack that. Next year rates might come down, but when they do, the competition comes roaring back. Cap rates compress and prices go up. So yes, you'll get a lower interest rate, but you'll also probably be paying a higher price for that same property. Buying today is like getting in early. You're picking up the property at a discount while other investors are sitting on the sidelines. And when those sidelines empty out, you're already holding the asset that's appreciating. Think of it like getting tickets to a concert. If you wait until the day before, you may save $10 on fees, but you'll pay double from a reseller. Or worse, you won't get in at all. Objection number 2 from an investor might be there just aren't any good deals out there right now. You might respond, well, that's a common perception, but it's not reality. Deals are out there, and they don't always show up with a bow on top of it. They're buried in distressed owners, in loan maturities coming due, or in properties where the seller's motivation isn't obvious from the listing. Your advantage is that you've got access to off-market conversations. You've got your ear to the ground, and you can uncover opportunities before they hit the open market. It's a little like fishing. You cast from the shore with everyone else and hope to catch something, or you can go where the water's deeper, where fewer people are willing to paddle out, and that's where the big ones are. So the question is, are there deals? That's not the real question. The real question is, do you want to be one of the few positioned to spot them early? And then another objection from an investor might be, well, the market's just too uncertain right now, so I'm going to hold off. Your response might be, I get that, but here's the truth. The market is always uncertain. The investors who wait for perfect certainty usually wait themselves right out of opportunity. The ones who succeed are those who invest based on fundamentals, strong tenants, good locations, and sound underwriting, not crystal balls. It's like waiting for a stoplight to turn green in all 4 directions. It's never going to happen. At some point, you've got to drive forward. Now, let me shift gears for a minute, once again, and talk with you about you. Because all of the market analyses in the world don't matter if you don't have a system to generate business. Here's the reality. Your survival doesn't depend on one home run deal. Sure, a 7-figure commission feels amazing. But if you build your career on hoping for lightning to strike, you're in trouble. What really keeps you alive in this business is consistent prospecting. And when I say consistent, I mean systematic. Every week you should be mining for opportunities. Some of the places like expired listings, commercial properties that didn't sell the first time around. That seller might be frustrated, but with fresh strategy and fresh energy, that's often a golden opportunity. Distressed owners, people staring down refinance pressure, vacancies, or partnership disputes. If you can bring them solutions, you win their trust and their business. And again, we can find distressed opportunities on software like Reonomy. How many people have their buildings refinanced 4.5 years ago? We can locate those. And loan maturities, properties with debt rolling over in the next 12 to 24 months, are often ticking time bombs. The financing environment today may not support their old business plan, and that creates leverage for you to step in. Think of your pipeline like a 401k. You don't dump your life savings into it once, pat yourself in the back, and never look at it again. You make small, steady deposits over time, and it's the same with prospecting. A little bit every day builds a pipeline that pays you tomorrow and next month and next year. Now, here's a hard truth about follow-up. Most agents quit after 1 or 2 touches. They send an email, they leave a voicemail, they may even make a second call, and then they assume the client's not interested. Meanwhile, research shows it usually takes 5, 6, or even 7 touches before the client is willing to engage. That's what we call the persistence gap, where most agents give up, but top producers keep going. And that gap is where the money is. So let me put it in perspective. One follow-up is like going to the gym once. You don't get abs. You don't even get healthier. You just get sore and complain about it to your friends. But if you keep showing up consistently, the results compound. And it's the same with prospecting. Let me explain that often these people will call you back and say, "I'm so sorry I didn't return your first 5 calls. But I was so busy with something else. Here's what I'm looking for." Now, here's your mindset shift. Treat your follow-up not as nagging, but as professional persistence. Every time you reach out, you're positioning yourself as the reliable, consistent professional who will be there when the client finally decides to act. And that's how you move from starving between deals to building a career that feeds you year after year after year. Now, let's look at a real-world type scenario that many of you are running into in today's market. Picture this. You've got a $10 million suburban office building. Okay, maybe it's $1 million in your market, maybe it's $100 million. But you've got a $10 million suburban office building. It's sitting 40% vacant post-COVID. And there's a $5 million loan maturing in only 12 months. And when it resets, the interest rate is going to nearly double the owner's debt service. This is not a rare situation. In fact, across the country, billions of dollars in commercial loans are coming due in the next 2 years. Many of those properties simply won't cash flow under the new financing terms. So what happens? Owners face tough choices, and that's where a skilled broker can become invaluable. Again, here are the facts, and I'm calling this the perfect storm. $10 million suburban office building, 40% vacancy rate. There's a $5 million loan maturing in 12 months, and when it resets, that interest rate is going to nearly double the owner's debt service. What do we do? Again, billions of dollars in commercial loans are coming due in the next 2 years. We can find them on Reonomy. We can find them on other software as well. And many of those properties simply won't cash flow under the new financing terms. So let's walk through the possible paths. Sell at a discount. The simplest option is to put it on the market and accept a lower price. The challenge? With a 40% vacancy, buyers will demand a steep discount because the income stream isn't stable. But it gets the owner out before they leave equity on the table, doesn't it? Number 2 is to re-tenant aggressively. That option is to focus on leasing. If the owner can bring that vacancy down before refinancing, they improve the property's NOI, which improves the valuation and refinancing term. But re-tenanting takes time. It takes tenant improvement dollars and aggressive marketing. And not every owner has the cash or the appetite for that. Third choice, convert to another use. Conversions are becoming increasingly common. Maybe that office building has the right bones for medical space, or maybe a flexible industrial use space, or even residential if zoning allows it. And that strategy can unlock huge value, but it's a capital-intensive project and it comes with risk. Last one that I have in this, and you might come up with some others, is partner with equity. If the owner doesn't have the resources to stabilize or convert, Bringing in a joint venture partner or private equity investor can provide the capital needed. The owner gives up some of the control or upside, but it saves the asset and avoids a distressed sale. Now, why are we talking about this? Because these are the exact situations happening right now in markets across the country. And most owners are not creative deal structurers. They're looking for someone who can lay out these options clearly and guide them. This is where you shine. You're not just a broker saying, I'll put up a sign and hope it sells. You're an advisor who can walk into the owner's office and say, here are 4 realistic paths forward. Let's talk about which one fits your goals and your resources. And that is the difference between being a commission chaser and being a trusted partner. Creativity plus knowledge equals opportunity. And the agents who master this approach, especially in challenging times, are the ones who win the business. They're the ones who build long-term relationships and position themselves as indispensable. All right, let's bring all this together. Here's the bottom line. In times like these, the easy deals disappear, and the market tests who's truly prepared. But that's not bad news. It's good news. Because this is where the best agents rise above the pack. Don't be an order taker. Anyone can unlock a door, forward a PDF, or repeat what the seller told them. Be an advisor. Be the one who brings solutions and creativity and clarity when clients are overwhelmed with uncertainty. Market shifts are not setbacks, they're invitations. Invitations to show up differently. Invitations to prove your value. Invitations to step up as a professional when everyone else is hiding under their desk waiting for things to get better. Your client needs 3 things from you right now: steadiness, creativity, and consistency. Steadiness, be the calm voice when they're nervous. Creativity, bring them options that they hadn't considered. And consistency, keep prospecting, keep following up, and keep building that pipeline. If you do these 3 things, you're not just going to survive in this market, you're going to thrive in it. And remember, in commercial real estate, the early bird doesn't just get the worm. The early bird gets the distressed seller, the discounted property, and the ability to say to everyone else, well, you should have called me sooner. So here's my challenge to you. Don't walk out of here thinking about how tough the market is. Walk out of here today with a plan to be the advisor your clients desperately need. Prospect harder, follow up longer, use your tools, and sharpen your skills. Because this market isn't just a test, it's an opportunity. And if you seize it, you're not just closing deals, you're building a career that's going to stand strong through every cycle. Let me leave you with a couple of thoughts. Number 1, in commercial real estate, the sky is not falling. It's just on sale. So go grab a piece of it before someone else does. Number 2, remember the best time to prospect was yesterday. The second best time is right now after this presentation. You got to listen to me close out first. So get moving. And finally, commercial real estate isn't about waiting for the perfect conditions. If it were, we'd all be retired by now. So buckle up, get out there, and go make some deals happen. Again, I'm Loren Keim, your personal real estate coach for commercial real estate, your favorite real estate coach. And thank you so much for joining me here today.